Hello again. In the two upcoming videos, we're going to discuss the concepts of leverage and break-even point. Leverage and break-even point are closely related and their formulas are based on the same assumptions. Leverage provides information on how sensitive different categories of earnings are to changes in different items of a company's income statement. The break-even point shows how much a company must produce and sell so that its net income is zero. In this video, we're going to discuss leverage. We'll start with the definition of leverage and the types of risks an enterprise is vulnerable to. Then, we'll show you how to calculate leverage and how to interpret the degree of operating leverage, financial leverage, and total leverage. Let's start with the basics. Leverage increases the volatility of a company's earnings and cash flows. The greater a company's leverage, the greater its risk and the discount rate used for the company's valuation. The company's cost structure affects the level of leverage. Basically, costs are divided into variable costs and fixed costs. Variable costs are costs that fluctuate with the level of production and sales. These could, for example, be costs of materials or shipping charges. Fixed costs are not dependent on the level of production and sales, which means that they must be covered irrespective of the number of units sold. In the table, you can see two companies with different cost structures. Both companies have the same sales revenue, amounting to $400,000, which is 50,000 times $8. With the presented sales and costs, the pair incorporated net income is $80,000 and is higher than the net income of Cherry Incorporated, which is $50,000. However, what seems interesting from the point of view of leverage is that the companies have different variable and fixed costs. You should know that a different share of fixed and variable costs in total costs results in different volatility of net income of both companies. If we assume that the sales increase up to 100,000 units, the pair incorporated net income will be 100,000 times 8 minus 5 minus 70,000, which makes $230,000. And the net income of Cherry Incorporated will be 100,000 times 8 minus 2 minus 250,000, which is $350,000. Thus, we can see that Cherry Incorporated is characterized by higher volatility of the net income resulting from the changes in sales. In this case, the risk is higher, which results from the fact that fixed costs have a bigger share in the general cost structure of Cherry Incorporated.
If I understand it correctly, the higher the leverage, the better. The net income of Cherry Inc. increased more substantially than that of Pear Inc. I always thought that higher risk is no good.
As you know, in finance, risk is closely associated with volatility and deviation from the expected value both upwards and downwards. If Cherry Incorporated has higher leverage, then if its sales revenue rises, the earnings go up more than in the case of Pearl Incorporated. However, you must keep in mind that in the case of a lower sales revenue, the losses become greater as well. That's the way risk works in finance. Let's assume that the companies manufacture and sell 40,000 units. What net income can we expect? Net income of Pear Incorporated is 40,000 times 8 minus 5 minus 70,000, which gives us 50,000. Thus, the net income decreases by $50,000. Net income of Cherry Incorporated is 40,000 times 8 minus 2 minus 250,000, which equals minus 10,000. It means that Cherry Incorporated takes a loss of $10,000 and its net income decreases by $60,000. That is more than in the case of Pear Incorporated. Let's now move on to the main risks involved in business activity. We can distinguish 4 types of risk: business risk, sales risk, operating risk, and financial risk. Business risk is the risk associated with operating earnings, which, in turn, depend on revenues. As you know, revenues are influenced by a large number of factors such as economic and demographic factors, legal regulations, etc. Hence the presence of business risk. Typically, companies operating in the same industry have a similar level of business risk. Business risk consists of 2 components. The first is sales risk, when the price or quantity of products or services is different than expected. The other component of business risk is operating risk. It depends on the ratio of fixed costs to variable costs. The higher it is, that is, the greater the share of fixed costs in total costs, the greater the operating risk of a company. Let's say more about sale risk. The greater the standard deviation of the number and price of the units sold, the greater the sales risk. In the case of Pear Incorporated and Cherry Incorporated, used in our first example, the expected sales, price and costs are equal. If, for instance, the standard deviation of units sold by Pear Incorporated amounted to 1,000 units and the price of deviation equaled $3, and if in the case of Cherry Incorporated it was 2,000 units and $5 respectively, the sales risk would be much higher in the case of Cherry Incorporated. We would say then that Cherry Incorporated is characterized by a wider distribution of operating profit. Let us now move on to operating risk. We are also going to say a few words about the degree of the operating leverage. A high level of fixed operating costs makes it difficult to adjust a company's operating costs to changes in sales and increases operating risk. Notice that cost structure can vary even among companies engaged in similar business activities, and so can operating risk. What is important in the context of costs is elasticity. It is a measure of the sensitivity of changes in one item to changes in another. The degree of the operating leverage, or DOL for short, which is a measure of operating risk, is based on this concept. DOL is the ratio of the percentage change in operating income to the percentage change in units sold. This is reflected in this formula. How should we interpret DOL? If DOL equals 1.3 and sales increase by 4%, then the operating profit will grow by 1.3 times 4%, that is, by 5.2%. Note that if sales didn't increase but decreased by 4%, then the operating profit would fall by 5.2%. An important category of the income statement item here is operating income, which can be calculated using this formula. The operating income equals the product of the number of units sold and the difference between the price per unit and the variable cost per unit less fixed operating cost. The difference between the price per unit and the variable cost per unit is called the per unit contribution margin. If the per unit contribution margin is multiplied by the number of units sold, we get contribution margin. So, the operating income is equal to contribution margin minus fixed operating costs. The following formula, however, helps you with exam questions where you need to calculate the degree of the operating leverage. In this formula, Q is the number of units sold, P is the price per unit, V is the variable cost per unit, F stands for fixed operating cost, and Q times P minus V stands for contribution margin. So, the numerator is the contribution margin and the denominator is the contribution margin minus fixed operating costs. In the next example, I'm going to show you how to calculate degree of the operating leverage. Cherry Incorporated produced and sold 50,000 units of a product at the price of $5 each. The variable cost per unit was $3 and the operating fixed costs were estimated at $60,000. The degree of the operating leverage is equal to 50,000 times 5 minus 3 divided by 50,000 times 5 minus 3 minus 60,000 equals 2.5. A degree of operating leverage of 2.5 means that the change in sales by 1% will result in a change in operating profit by 2.5%. As it turns out, DOL depends on sales, and depending on sales level, it has a different value. If we use the data from the last example and calculate DOL for the sales of 100,000 units, we get DOL equals to 100,000 times 5 minus 3 divided by 100,000 times 5 minus 3 minus 60,000 and amounts to 1.43. So, when sales are equal to 100,000 units, then if revenues change by 1%, the operating profit will change by 1.43%. The principle is that when a company has a positive DOL, the DOL decreases when the number of products sold increases. Why is that? Because as the number of products sold increases, the proportion of variable costs in terms of value in the structure of total costs increases too. So, the proportion of the fixed costs in total cost decreases and, as we know, it results in decrease in operating risk. What is also important is that in the case of a negative operating profit, the degree of operating leverage will also be negative. Remember that operating profit is most sensitive to changes in sales volume. If sales are close to the operating break-even point, the operating break-even point is the number of units sold at which the company's operating income is zero.
Yes, great. Everything is clear. But how big is DOL when operating profit is exactly equal to zero?
Good question. In this case, it is impossible to calculate the DOL. Let's look at an example. Cherry Incorporated produced and sold 30,000 units of a product at the price of $5 each. The variable cost per unit was $3 and the operating fixed costs were estimated at $60,000. The degree of operating leverage in the case of selling 30,000 units is 30,000 times 5 minus 3 divided by 30,000 times 5 minus 3 minus 60,000 equals 60,000 divided by 0. And, as we know, we can't divide by 0, so in this situation there is no DOL. And now, to sum up our discussion about DOL, we're going to analyse again the previous example in which we calculated the operating leverage with sales equal to 100,000 units. This time, let's assume that sales increased from 100,000 to 120,000, so by 20%. If you know that the operating leverage is 1.43, you can calculate the percentage change in operating income using these two values. The percentage change in operating income is 20% times 1.43 and equals 28.6%. As you can see, if the company's operating leverage is 1.43, then with an increase in sales by 20%, the percentage change in operating income will be 28.6%. Our examples illustrate that the two types of business risk, that is sales risk and operating risk, have a strong impact on a company's activity, and their level is highly dependent on the industry in which the company operates. However, when it comes to operating risk, the management may control it to a certain extent. Let's consider a case when a company wants to buy new equipment. Whether a product is made using an old or a modern machine has no effect on the sales volume. However, this new equipment can affect the cost structure and, more specifically, the ratio of fixed costs to variable costs. It is an analyst's job to forecast how such an operation will influence costs and, consequently, the company's operating risk. Companies which spend most of their funds on research and development of their products but spend relatively little funds on their production and distribution are characterized by a high degree of the operating leverage. This is due to a high proportion of fixed costs in the cost structure. Such companies include computer and pharmaceutical companies. The opposite of such companies are companies that generate mainly variable costs, which depend on the volume of sales, so the degree of their operating leverage is quite low. These are mainly companies operating in the retail sector.